It doesn't matter if you're 19, 30, or 50 years old, we all need to consider our retirement plans. The sooner you start, the better. Hi, if you're new, welcome. My name is Karen. I am a qualified chartered accountant and entrepreneur based in the UK. I am on a financial freedom journey and I post new videos every week covering topics and strategies on personal finance and wealth creation. In this video, I will take you through UK pensions and explain important factors you need to understand. Let's start with what a pension is. A pension is a tax-efficient way to save towards your future retirement. You, your employer, or the government put in money into a pot which is then invested in assets such as stocks and bonds in order for it to grow. There is therefore a risk that the value of your pension pot can go down. This is the case with any investment, but you can take certain steps to reduce the risk. Once you reach the retirement age, you can then use this money to support you, as you are likely to no longer want to work or be able to work. If you die, you can pass on your pension pot to loved ones, so this is an added advantage. You should be aware that pensions are not the only way to prepare you for your twilight years, as you can combine different methods of investment. Click that thumbs up icon if you already have a pension. In this video, I will cover 3 types of pensions. Firstly, state pension. Second, private pensions. And last, employer or workplace pensions. Starting with state pension. This is the pension that the UK government give you when you reach the official retirement age, which is currently 66, and likely to go up to 68 by 2039. Because people are living longer, the government is gradually increasing the retirement age in order to reduce the financial burden. This government pension goes up every April by either inflation, the increase in average earnings, or 2.5%, whichever is higher. The amount of state pension you get is usually based on national insurance or NI contributions that you paid during your working life. To receive the full pension, which is currently £172.50 per week, you must have paid or been credited with 35 full years of NI contributions or credits. Credits can be earned if you're unable to work, for example, due to raising a family, long-term illness, or you're caring for someone. You need a minimum of 10 full years to be eligible at all. So if you have 10 years of qualifying NI contributions, you will earn 10/35 of the pension amount. So you would calculate that as that £172.50 multiplied by 10 divided by 35, which gives you £49.29 per week. These qualifying years do not need to be consecutive, however. These can be spread over a long time. I will leave a link to the website gov.uk so you can find out more information about state pensions. Moving on to private pensions. A private pension is known as a self-invested personal pension, or SIPP. This is something you set up on your own, which is common for self-employed people. You can also set up one even if you contribute to an employer pension. This type of pension is managed by a SIPP provider, with you making all the investment decisions, which gives you more control compared to an employer pension. Just make sure you are aware of the SIPP provider's charges and fees. You can get access to your pension at the age of 55 compared to the government retirement age of 66. It is a tax-efficient way to save, as government give you a tax rebate. 20% of your amount if you're a basic tax rate payer, and 40 if you are a high tax rate payer. So for example, for every £100 saved in your pension, the cost to you is only £80. Lastly, we will look at employer or workplace pensions. This is a pension set up by your employer, where you can opt to contribute a percentage of your basic salary. There are employers who can match employees' contributions or even put in more. For example, you may contribute 4%, and your employer will then put in 1.5 times that amount. The retirement age for this is the same with private pensions, which is 55. This too is very tax efficient. So let's say you contribute £100. Due to the tax benefit, the cost is only £80 because you will see a reduction of £20 in the amount of PAYE that is deducted by your employer. Then, on top of that, if your employer matches your contribution, it means each month you have £200 in your pension pot and you only had to effectively pay £80. The amount that your employer contributes into your pot is literally free money, essentially like a pay rise. So consider putting in the maximum that you can. Even when looking for a new job, find out if they contribute to your pension, and if so, how much. Because this really is a benefit. Even though you don't have access to the money now, you need to think long term. Government introduced auto-enrolment, which meant an employee above the age of 22 and earning above 10K would automatically be enrolled into the pension. From April 2019, under the auto-enrollment, total contributions must be at least 8%. So if your employer puts in 3, the employee has to contribute 5. If you do not want to make contributions, you can opt out. Otherwise, you're automatically opted in. This is therefore a very passive form of investment, as you literally do not have to do anything. You can put as much as you like into your pension, but there is a limit to the tax relief you get. Generally speaking, you can get a tax benefit to the maximum of your annual income. If you're deciding on whether to contribute to a pension or not, first think about whether you have high interest debts and consider clearing those first. When you then get to the age of retirement, you can choose from the following. First, to take 25% tax-free, then buy an annuity. An annuity is a product where you exchange your cash with an insurance company and receive a fixed income for life. Second, keep your pension invested and draw down as and when you need it. When you do withdraw cash, you get 25% of each lump sum tax-free. And then lastly, take 25% tax-free and then buy a flexible income drawdown product. If you still have more questions, feel free to drop them in the comments. And for financial advice, you can speak to an independent financial advisor. I believe your finances are your responsibility, so take control and make better choices that increase your wealth. I hope you enjoyed this video, and let's meet in the next.